Level 1. The 300 to 579 range. The denial that doesn't explain itself. You apply for an apartment. A week later, a polite email. Application not approved. No real reason given. Just a vague line about credit history not meeting requirements. You pull your report that night, and there it is. A number sitting in the 500s. You scroll down to see why, and the list isn't one thing. It's several. A missed payment from 2 years ago you genuinely forgot about. A collections account from a medical bill you didn't know had gone to collections. A credit card maxed out for longer than you'd like to admit. This is the range where credit stops being abstract and starts closing doors in real time. Not just apartments. Car loans with interest rates that make the monthly payment nearly double what someone with good credit pays for the same car. Security deposits that get larger because you're considered a risk. Sometimes even jobs, in industries where credit checks are part of hiring. The instinct here is to fix everything at once. That's not how it works, and chasing every problem simultaneously usually means fixing none of them well. The first move is narrower than people expect. Stop the bleeding. No new missed payments, starting today, because payment history carries more weight than anything else on the report. Then negotiate the collections account, because some creditors will accept a settlement and report it as resolved, which moves the number more than people assume for a single account. You don't fix a 500 score with optimism. You fix it with the boring discipline of not making it worse while you chip away at what's already broken. Level 2. The 580 to 669 range. Approved, but never on the terms you wanted. You get approved for the car loan. Relief washes over you for about 10 seconds until you see the interest rate. 14.9%. Your coworker mentioned theirs was 5.9% last month for a similar car. Same approval. Completely different loan. This is the range where the door opens, but everything behind it costs more. Credit cards exist, but with lower limits and higher interest rates. Mortgages exist, technically, but the rate difference over 30 years can mean tens of thousands of dollars more paid for the exact same house as someone with a higher score. Nobody tells you this part out loud. The approval feels like a win. The fine print is where the actual cost lives. The frustrating thing about this range is that you're not doing anything dramatically wrong anymore. You're paying bills mostly on time. You're not in collections. But the older damage is still sitting on the report, and recent good behavior takes time to outweigh it, because scoring models give more weight to consistency over time than to a few recent good months. What moves the needle here isn't a single dramatic action. It's utilization, the percentage of available credit you're actually using. Someone with a $2,000 limit carrying a $1,600 balance is using 80%, and that number alone can suppress a score significantly, even with perfect payment history. Pay that down to under 30%. And for some people, the score moves more in a few months than years of on-time payments alone would. Level 3. The 670 to 739 range. The score that feels good enough until you compare offers side by side. You're refinancing or shopping for a new credit card or pre-qualifying for a mortgage, and for the first time you pull up 3 offers next to each other instead of just taking the first one. Same loan amount, same term, 3 different rates, and the spread between the best and the worst is wider than you expected for what felt like a solidly good score. This is the range that feels like a rival, and in a lot of ways, it is. You're approved for almost everything. Decent rewards cards, reasonable mortgage rates. Nobody's denying you anything. The problem is subtler than denial. It's that good and great are charged differently, and the gap compounds over the life of a 30-year loan into a number large enough to fund a kitchen renovation or a few years of retirement contributions. Most people in this range stop paying attention to their credit entirely because nothing is actively going wrong. That complacency is exactly what keeps them here, instead of climbing higher. The accounts that pushed the score this far are often newer, which means average account age is still working against you. Closing an old card, something that feels harmless like cleaning up a wallet, can actually shorten that average age and quietly cost points. Nobody notices losing until the next big purchase, when the rate offered is worse than expected, and there's no obvious reason why. Level 4. The 740 to 799 range. The lender calls back with a counteroffer nobody asked for. You apply for a mortgage, and the loan officer calls, not to deny you, but to mention, almost in passing, that you're 17 points away from the next pricing tier, and at that tier the rate drops noticeably. They ask if you have anything you can pay down before the rate locks. You didn't know that tiers existed at this level of specificity. You assumed good credit was good credit. Full stop. It isn't. Lenders price risk in bands, and the difference between the top of one band and the bottom of the next can be the difference between a rate that's merely fine and one that's genuinely excellent. This is the range where credit stops being about access and starts being about negotiating leverage you don't realize you have. You're not being denied anything. You're leaving value on the table without knowing it exists. A handful of people in this range, faced with that loan officer's question, scramble to pay down a card balance in the final days before closing, shaving off just enough utilization to cross into the better tier, and saving real money over the life of the loan for an effort that took one phone call and one payment. The mistake at this stage isn't bad credit behavior. It's assuming the work is finished because the score already looks impressive on paper, and never asking what's actually sitting just out of reach. Level 5. The 800 to 850 range. The moment you realize the number stopped mattering and something else took over. You apply for a new card, mostly out of curiosity, expecting instant approval the way it's always gone. Instead, there's a brief pause. A request for proof of income. A question about employment history you weren't expecting at this score. For the first time, the credit score itself isn't the bottleneck. You're well past any threshold that affects pricing or approval odds in any meaningful way. What lenders are evaluating now is something the score doesn't fully capture: actual ability to repay, debt-to-income ratio, total existing obligations relative to what you bring in. This is the range where people learn, sometimes for the first time, that a perfect score and a strong financial position aren't the same thing. You can sit at 820 and still get a measured response on a large loan application if your income relative to existing debt doesn't support the amount being asked for. The number on the report opened every door. It's not the only thing standing in the doorway anymore. The realization here isn't about fixing anything, because there's nothing broken. It's about understanding that the goalpost moved without announcing itself. Maintaining this range takes almost no active effort, just continuing the habits that built it. But the next financial milestone, the bigger mortgage, the business loan, the larger credit line, gets evaluated on a fuller picture than the three-digit number that used to be the entire conversation.